Okay, then. I think we can start. Let's go. Just let me do a quick check. Good morning. I'm Giuseppe Basile. Thank you for being here. Please give me a yes if you hear me, if you hear my voice. Go ahead. Just type on the chat a yes. Okay, very good. Okay, good morning, Pantelis. How are you? Good morning, everyone. Thanks a lot for joining in. Okay, so very good. So let's get started then. Okay, so as you know, I'm Giuseppe Basile. I'm also known as the Fib Stalker. That's quite an aggressive name, isn't it? But I promise you that I'm a stalker only in the financial market, actually, and it's aggressive. Yeah, it's an aggressive name, but I'm always seeking to make our way in a very competitive business. So that name can well be appropriate. So I want to thank you for tuning in today and taking the time to watch this webinar. I really hope this webinar is useful. I think it contains truth about the market, which is very important to understand. And I also want to thank, of course, FX Street, Adinda, and all the staff for having me set up and giving me the opportunity to present here today. So thank you very much. Today I'm going to talk about the bandwagon theory. And during the years, I decided to illustrate the theory and also relate it to the modern market. So a little bit more in a minute. The agenda of this webinar is going to be this one. So I'm going to have a little introduction about myself. I'll talk about the bandwagon theory. So I will introduce the bandwagon theory. And after that, I will illustrate the theory on the euro dollar, on the daily chart of the euro dollar. In the last part of the webinar, I'll present the bandwagon theory within the current context, the current market context, and specifically, I'll make reference to the New Zealand dollar versus US dollar, and I'll also try to show you how that plugs into the way markets move, the modern markets move. And modern markets, we all know, are governed by algorithms. And in the Fib Stalker method, I attempt to capture the footprints of these algorithms on price. So after that, I'll have a QA and I'll answer your question. Now, what I suggest is that you can keep writing your questions on the chat. I'm not going to read them. And I will interrupt every now and then, and we can go to the question. So don't be worried. I'm not ignoring you. You can write your questions, and I'll answer them. So before we continue, give take a look at the disclaimer here. I'll always mind the risk. I have an acronym PPC, protect precious capital, and that's rule number 1 of the game. So if the money is gone, the game is over. And being exposed to brokers very recently, I had the opportunity to discuss with the head of sales of a large global broker. And he mentioned to me that still 22% of traders do not use stop losses. And as a result, they get margin calls. And if you are one of them, I believe you should really stop trading. And we know that in Western countries, newbies and average traders lose between 2,000 and 6,000 in 3 to 6 months. So I'm very adamant about it. I mean, I'll spend a little bit more on this slide, but that's very important for me. And there is another. So if you're watching the recording of this webinar, please pause the video now and read the disclaimer here. Another thing I'm fan of. It's very important for me is to make sure that we do things differently. And in fact, I always ask myself what I'm doing differently so that I don't become statistic. So I become a winner rather than becoming statistic. So just keep this thing in mind. And I hope today I'm going to give you an idea of how we can do things differently. Very quickly about myself, computer science engineering in 1999. My interest in trading started in 2001, committed to research quite immediately. But I understood, fortunately, the importance of mentoring only later on in 2006. I had some mentors, worked with One Tarp, Ivica Juratic, D.R. Barton, David Aisley, Joe Di Napoli, just to only to mention a few. After I earned my computer science engineering diploma, I started working for Accenture, a consulting company. I worked for Accenture for 10 years. In 2009, I decided to leave the company and to dedicate full time to trading. And in 2009, 2013 alone, I've added more than 7,000 hours of screen time on top of the almost 10,000 I had already. In 2010, I completed a master's in finance in Dublin, and 2012 became certified market technicians. And I started fibstalker.com in 2012 with the objective of sharing my own research now and training as well. Now, I'm an IFTA associate and researcher, so I've published in the last 3 years a number of papers, and actually I have another paper being reviewed at the moment by the scientific committee of the SIAT in Italy, which is the Italian chapter of the IFTA. I'm currently based in Toronto. I'm about to launch fibstalkertrading.com in the summer 2014 with 2 services, a market signal service and a mentoring course, which is focusing on market timing. Specifically, I'm going to disclose my fibstalking technique in detail. So that's about me. I want to start from last time, the June webinar. If you didn't have the opportunity to watch that webinar, please do. I think it's very important, especially the first part, which is free, and you can view that on fxstreet.com. So in that webinar, I spoke about how the market moves, and there are really few truths about the market, and they're not in books. They're rather in what I call the street smarts. They're rather grounded in market behavior. I busted a number of myths in that webinar, including the fact that technical analysis alone will not make you successful. And probably most of you already discovered that. Trading is a psychology game, and that's one of the reasons that prompted Mark Douglas to write the 7 principles and 5 truths of trading, and you should really know those very, very well. And again, I mean, I always look at methods that reflect aspects that are grounded in the way price behaves and market behaves. So we know the market moves in trends. Excuse me. And this will be very evident. And of course, we know that. I use this concept a lot. Modern markets are heavily participated by algorithms, and there is also a frequency trading, which has quite an important chunk on the equity market, between 35 and 75%. And finally, of course, one of the reasons technical analysis is not successful is that it's late. It provides late signals, and the statistics are not significantly good. So let's dive into the bandwagon theory. So, excuse me. So what is this all about? This is an allegory for market behaviors, and I believe it's worth alone the equivalent of really months, if not years, of trading exposure. And I also wrote that on the summary of this webinar. Now, I read from Mike, I think with technical analysis, you can be very successful. Mike, that's true. But what I'm trying to say is that the success does not reside into what the technical analysis itself can give in terms of signal. It resides in being disciplined and using a very solid risk and money management, which the average trader and the starting trader does not have. So I know this is a very controversial point, so I'm not going to get into an argument here. Of course, you can be successful with technical analysis, but your success derives from the use of other elements that are very important in trading, and this is 15 to 20% money management and 60 to 75% psychology. So I agree with you, but it's not easy and not alone with technical analysis. So the next part is that, okay, so I believe that the bandwagon theory can save you a lot of time, money, and mental pain as well. And this is not an overstatement. In fact, I believe that understanding really profoundly the message and hidden wisdom in the theory can create the condition for you to reach true trading mastery. And the theory provides an insight into the inner workings of the markets and how the average trader is manipulated for profit. Now, maybe manipulation is not totally fair. We should really speak about self-manipulation here, because only the trader can cause his own demise. No one can actually take your money from you without you wanting it. And in fact, I will also clarify that the main problem here is that is due to the psychology really people bring into trading from their everyday life activity, and that's not very useful in my belief. It's this useful for correct and consistent trading, and I covered this concept also in my free ebook, Key Concepts to Correct Trading Behavior. If you haven't read that, you can go to my website and download it for free. And let me know what you think about that. So the responsibility for poor trading results in the, so we have actually, sorry, what I want to say, we have the responsibility for trading results that we get, and that resides mainly in lack of market-oriented psychology. As traders, you might ask, and actually I'm going to ask that to you. What do you think a trader is paid for? Why we are paid for? What we are paid for as traders? Just give me your thoughts on top of your mind, just very quickly. Tap it down. Well, I'll answer this. This is actually, we are paid for the quality of our decisions. So losing money clearly means that the decision and the execution process is ineffective, and professional traders understand that. Now, bad trading decisions are exactly that mechanism that cause the transfer of wealth from the larger group of average traders and hedgers onto the smaller group of consistent professionals, and allow me again to tackle in and ask you ask you to ask yourself, what are you doing differently? What am I doing differently to avoid average results? Market professionals are what I call the elite 5%, and this continued transfer of wealth, it's what keeps the market moving. It is important and beneficial that you make no assumptions about the bandwagon theory, but rather keep your open mind and consider whether the bandwagon theory could really describe the real truth about the markets. I'm continuing here. I'm assuming that you can hear me. Is that a fair assumption? Please give me a yes if that okay. So what I do, I often encourage traders to carefully study and think about the bandwagon theory. And now, if you think that professionals matter individuals, well, they're not. Let me bust that myth. They just know and understand how the crowd decides itself, and they leverage a widespread weakness. So, trading in the end, it's about understanding how we are deceived continuously until we understand the rules of the game, and the edge of profession is functioning from a different set of belief about the market, and how actually the participant behaves. So it's up to you really to make your choice and decide which side you want to be on. So now the bandwagon theory, it's not something that I created, of course. It's documented in the Tools and Tactics of the Master Day Trader. It's a book from Velez and Capra, and you can find that at page 29. Now, you can also Google it. You can go to my website as well, and you can Google it, and you'll find that anyway. So the theory, as we said, is an allegory. So in this part, I'm going to start illustrating the theory on the euro-dollar chart. Specifically, I'm going to make reference here to the daily chart in the last part of 2010. And then I'll switch to my platform and show you how that applies to current trading as well. So the theory is an allegory. So it may be a little bit difficult to link it back to actual practical trading and to price behavior and that's the reason why in the past, in 2012, I decided to make the theory easier to understand. And to do that, I illustrated here it on the euro dollar in 6 steps. So the bandwagon theory itself is expressed as in prose. So I'm going to read some section excerpts from the bandwagon theory and then explain that how it applies to market behavior. I hope you find this interesting. Now, the first time I've read about the bandwagon theory, I just dismissed it as non-useful, totally unuseful to me. What a mistake I did. And only a few years later, actually, when I started getting interested in psychology and algorithms, I understood how important was the bandwagon theory. And so it's very important to, and gives really an idea of the difference of behavior between the professional and the average trader. And, I wouldn't say I'm an average trader at the moment, but for years I've been an average trader and I kept doing the same mistake again and again. So let's start from step one. I'm going to read for you excerpts from the theory. So imagine a bandwagon that is rolling forward at a quickened pace. The music, that is very pleasing, is loud and clear and starts to attract many others onlookers that happen to be idly standing on the sideline. So look at this. Where are we? We are in a situation, this is the explanation, we're in a situation which the market is moving higher. It's in a trend. And the trend is already well established, and late players and I'll explain you later, former victims jump on the bandwagon. And actually, these are traders who jump into the market at in these areas here. Now, I don't know if you can see that. That's always a problem I have. But anyway, you're speaking about people who enter in the areas of price which are indicated by the arrows here. And it's late and it's going to be a troublesome trip, but still some profit can be done, okay? So now, as the crowd of the new party animals on this bandwagon grows larger, the bandwagon finds it harder and harder to move forward at the same page. The bandwagon slows down, and late onlookers jump on the crowd, on the bandwagon, and the crowd grows even larger. So here again, we have a situation where, and again, I cannot show this, there is a situation in which the trend is about to end. We know this in hindsight. Normally, you don't see this. But you have to expect retracements as well. And that's part of my edge with the fixed alternative. And people here are entering this market long, they are late, and there is still a little bit of profit to be done, but mostly this new position will show a loss very, very soon. So more people get on board, and the trend and the trading market starts decelerating here. The move higher is almost completed, as I told you. And price here is ready to reverse, and here as well in October and November 2010. So opening a position at this stage is clearly a mistake. It's too late, and losses, as I told you before, are very probable. And but yet this is what a lot of retail traders regularly do. They open position in what they believe is the direction of the market, and then the market actually reverses on them, and they show a loss almost immediately. So Wall Street professional and Forex professional and commodity professional and hedge funds, they sell in this situation long to retail traders in this stage. So I hope you start getting the picture here of what the bandwagon is. So the next step, now that the bandwagon is at a complete standstill, more people jump on. The point is that the bandwagon it's motionless, and it's unnatural. In fact, the market they have to keep moving. Price keeps moving, and how Mark Douglas rightly put it, it takes only a trader to change the outlook of the market, because it only takes one trade from one trader to push market below some important levels that would trigger, for example, the institutions' participation. So this emotionless and unnatural state cannot last. The crowd piled on the back, it's much too large, and the bandwagon quickly shifts into reverse and jolts backwards, knocking a few of the party animals off the back. And this is this move lower that we see here, especially in October. I think it's very evident. So the music stops, a puzzle phase begins to emerge, another backward jack takes place, as we can see here. And again, I cannot annotate this without showing the picture, but basically we are in this area here. And another backward jerk takes place, only this time it's not violent. So in this stage, people get onto the move higher that is about to end or is ended already, and price starts moving against the trend, and some people are stopped out. So the idea of the allegory of people that are thrown off the bandwagon, it's actually people being stopped out. The price has just not reversed and actually confirmed the reversal yet. As I'll show you here, in October and November, price did not get to the target of program trading as well. So the price is moving laterally in this stage. The next stage, really the reality now sets in. The fun has turned into a nightmare, and panic begins to run rampant. The jolts backward continue. Each successive more violent than the last, and final thrust backward is so vicious that also the last of the hangers on crashed on the ground. And so those who enter late here are in panic and are being thrown off balance, and some of these people will actually hold on the position all the way into the 50%, all the way into where program trading is active here. So what happens here is that eventually these people will be stopped out of their position, and some people pushed by greed or cognitive dissonance, or even frozen by fear, they will still hold on their long position, for example, now showing a loss. And I know some people who found themselves in that situation Even recently, I myself find in the past in that situation. And eventually these people will be stopped out, and some of them will actually be stopped out near the swing lows. The next step is when something interesting starting happen here. At this point, a new group of onlookers emerge from the nearby woods, and they are serene and energetic. Each movement they make is deliberate. The seemingly new group is not new at all. It's the same group that was seen quietly exiting the party before it came to its violent end. And this group is, of course, the group of smart money, and they not only exited the part early, they actually were the originators of it, and that's the whole point, right? So it is my belief that markets are controlled to a certain extent, meaning that there are classes of algorithms that really move the market when there are no other elements that move the market, like news, like decision of central banks, like geopolitical situation or changes in macro economic condition. Now, this might look a very bold statement that markets are controlled. And you can decide what you make of it. I base all my trading edge on it, and I'm not the only one. So in this phase, those who were not yet thrown away by the market, those that were still in their long positions, are actually give up and thinking that the move will continue lower. For example, if we are here mid of August 2010, a lot of people will believe that this will continue lower. But here there is an area of support and participation on the long side, as I'll show you later on. So there's no reason to believe that. The point is how we decide when there is enough participation to start pushing this market higher, or when there is no participation, so that the market keeps sliding downwards. And there is a way of doing that. I use my flip stalking technique to do that. Those who exit in panic or disgust by price action do this near or very, very close to lows. And in the meantime, a new group of smart money traders is actively buying the market here. And as you can see, there are this move higher and lower, which actually confuse a lot of people. The point is that when the sequence of measured move has failed, program trading will not, on the daily time frame in this example, keep trading this market on the downside. So, and there are ways to understand that. Last is the cycle begins again. So in a flash, the professionals are on board. Easy. The bandwagon now, free of the larger crowd, can move forward freely and gracefully. And that's really the start of a new trend here. And this is the start of this move higher. And after a few miles of uninterrupted movement, so after the market start moving higher a little bit, someone from this masterful group flips on a switch, and you understand what that is. Flip on a switch, and suddenly the loud sounds of entertaining music starts again. Do you know what that is? Well, that's news. That's media. And within moments, those who were the former victims from the backward crash become interested again, and the music almost calling them from the grave. So this, this is the whole allegory. Smart money traders can now easily and safely add to their position. Non-professional retail traders and professional traders, we don't believe that only retail traders lose money in the market. So these people, also professional traders, who do not have a clue of what is happening, do not have the emotional capital to get involved immediately again at these low prices, because they are totally destroyed by their previous and disastrous experience. Now, in the market, time can heal the effects of a loss and a bad experience in a very small amount of time. And when they are healed, then the strong emotion of greed, and especially fear of losing the opportunity, because don't forget, it's not about only about greed, it's all about fear of losing a very good opportunity that pushes us to get involved in the markets again. And we get involved in the markets again at the very wrong time, and the cycle starts again. We find ourselves again into the first of these 6 slides I've shown you. So as you can see, and this is the theory illustrated. Now, as you can see, it makes sense, right? I mean, it gives us an idea that we have to try to think counter trend and think against the normal way we would look at the market. And technical analysis from this point of view offers nothing new, because it's actually I'm saying about traditional technical analysis based on indicators and which are a function of price. So it does not offer anything new, because it actually help us being part of the bandwagon participants rather than being part of the smart money. And that's something that it's very, very important. Now, is this just a case or there is a pattern there? Of course, and I'm going to show you there is a pattern. Before I get into my trading platform, I want to remind you which are the levels, Fibonacci levels I use to model algorithms. I use the 50% as an entry and also as a level where support resistance starts, 61.8, the red line, as a stop loss and end of support resistance. And I use these 2 targets, 123.6% and 161.8%. And the green broken line is my first target. So let's look at my platform here now. First of all, do you have any question before I continue? Do you have any question on the bandwagon theory? Very quickly, please shoot questions on the chat, and I'm going to answer your question quickly. Otherwise, we will move this to the Q&A, and I'm going to talk about how this applies to trading first, and then we'll continue. So I see no questions, so I'll just continue. So before I get into the New Zealand dollar versus US dollar, which is the chart I want to focus on, let's go back just briefly to the euro daily, and of course the euro today is following the signal I gave on my weekly webinar. I mentioned this area. Sorry, my weekly newsletter. I mentioned this area 136.68 as the start of an area short here with a stop of 137.08, and Pantelis, as you can see, that anchor kept working very, very well. But that's not what I want to talk about. I want to go back to 2010 and look at this market and look at what happened here. This is exactly the sequence I've showed you that I used to illustrate the allegory. And as you can see here, the market, when we saw this market correction here, the market was correcting into an area of support starting at 126.01 with a stop below 124.28. Now, the sequence of measured move here failed, and I can show that to you very easily. We had this measured move hitting first target, and then in one of these jolt backwards of the bandwagon, as you can see here, the sequence failed, and that was our indication that the participants at 126.91 were actually interested in buying this money. When you see this, then you wait for the market to correct, and then that's the place where you enter. But most importantly, look at what happened here, and that's very interesting, because program trading always tries to push price into their target. And we had one target, the first one 136.77, and the second one 142.36. So as you can see here, the bandwagon started jolting back and forth, but the second target was not hit just yet. So we could actually, and the sequence of measure move did not fail. So higher did not fail. So there was an indication that the market was not ready to move lower. Okay, I just wanted to pinpoint this. When we move to the New Zealand dollar versus US dollar, I'm going to show you the same pattern here. But before I get into the daily, I think we remember that I've used this example also in a previous webinar. We will get in a minute into this. Let me show you on the weekly time frame what there was in this market. And I'll remove these levels, but these are the levels that are important. So we had an initial measure move here from lows to highs with price participating at 0.6560, which were pressed into first target and could not make it into second target. So the next measure move initially did not hold, but then eventually started holding here, and that happened late in 2013 here, and we saw participation at this 0.77 area. And within this move higher with area of support, there was another measure move. You can see here very, very clearly. And again, you can see here the pattern of the move higher, the correction into the area, an area of support, and price getting into first target. And look at how precise we're in this case. So I picked this market because it was one of the best markets for my method in the last few weeks and months. So, but you will see this pattern over and over again. Okay, so you can go ahead and study these patterns on other markets as well. So when we had this 081.11 area of support, 14 area of support here, we had the bandwagon going down and then start jerking, with its jolt higher, and actually, this is the violent last move we had into this area of support. Now, the question here is, how do we identify when that move lower gets into an area of potential support and there is actual participation into that area of support? So the way I do it is to look at what program trading is doing on the smaller time frame. And in this case, we can still see this on the daily time frame. So when we trace from A to B, and the way I do this, I see the high here, and then I start tracing to the lows, until price bounces, and then if it gets into that 50% area, then that's where I get note, and I want to see how the market behaves there. So now when we get into study into details what happened there, market never broke the 61.8% and start going down. I had this reaction, but eventually went into 0.6163 and then 0.8080. Now, here we have a market that hits the second target within an area of support, and the area of support again is this wider area here. Let me see if I can annotate this. Oh, nice, I can annotate. So this is the area of support, and the market gets into this area, and what we need to understand is if the sequence of measure move lower continues. So we hit the second target, we are moving in extension charts, and the next measure move, notice how the next measure move finds participation right at this level. And that's an indication that there was someone who's willing to sell this market share. But eventually, the participation on the upside and actually this participation on the upside, now we understand this is smart money coming into the trend, eventually push price well above this level here. And when this level here, the 081.54 is broken, then that's a confirmation that program trading and smart money is committed to this market. So I hope you start seeing the whole picture here. Now, another thing, so this is very important. This is how program trading and algorithm trading and my method relates to the bandwagon theory. So So the bandwagon theory is not just just a theory. It's an allegory that explains in normal people's words what's going on in the market. But then you can plug in other concepts and, for example, study how program trading and algorithm trading is affecting price. And actually, for me, program trading is the equivalent of smart money. Another thing very important is to understand when we have this move higher, and we know that now that we have a target here, where do we get involved? And it's very easy to get stopped, if we get at different levels, and because the market moves in trends. So where do we get involved? If we get involved here and we don't place the stop in the right place, which is below this level, so we need to know what this level is. We actually get stopped. So again, and this again relates to the bandwagon theory, the initial steps when the new onlookers start getting involved here. So the key is to model again program trading, to look at what program trading is doing. And that's, again, is the key for me. And if we look at this level, we saw that this level was early used by program trading. In fact, in the 4-hour chart and even in the daily chart, we can see that this trace was actually respected and was able to bring price into first and second target. So when we see this high, it's important to identify the anchors. And in my methods, it's all about identifying these anchors, which actually model how program trading is actually is actually trading these markets. And as you can see, when you use that anchor, we had a reaction lower here into an area of support, and the market never went below the stop level 083.45. And did you have to guess or put a stop here? No, you don't have, because you can study what the market is doing on the smaller time frame here on the 15 minutes. And when the sequence of measured move fails, you can get involved on the upside, because it's the same concept. It's actually the bandwagon theory working on the smaller time frame here. That program trading has got involved if the sequence of measured move shorts fails. And look at this. In this specific case, this measured move was able to bring price into first and second target. And now we know that the market is moving in extensions here. So we know that the anchor that program trading is using has changed. And that helps us to model the market, the next moves in the market. So that's the beauty of program trading. And I didn't pick this example, the New Zealand dollar versus US dollar, just because it's the best one. I mean, if you do this kind of analysis on all markets, you'll see that you'll be very successful, actually, because you'll be able to pinpoint areas where there is participation. And here again, we had participation. This move lower broke price right into that first target. Beautiful. Program trading taking profits here, and of course, again, what's the next measure move after those highs were hit? Well, again, we reuse the same anchor, and as you can see, the next measure move keeps holding. So now the target is here, and as you can see, the market does not get there. It retraces into this area again. And only in a second moment, it gets into target. And look at the beauty of this. So these are our time frame. And I'm going to show you, I think you already understood what's the reason for that, but let me show that to you. It's the presence of this profit-taking level on the weekly time frame. The beauty of this is that there are different programs working on the markets, and These programs on the weekly time frame had this level, the 08750 area as area of profit taking. And look at this, what happened. But this profit taking was not enough to actually scare the people and the setups can you hear me? Can you tell me at what point you lost the sound, please? Can you just tell me more or less where did you lose me, so I can actually cover that if necessary? And anyway, I mean, I hope you followed that 2 minutes ago. Okay, so let me go back then. So I was saying we had this third measured move here, and as you can see, it was respected because price never went below 085.10, and the price started moving higher, but did not get to the first target. This is the first target of this new measured move. And what's the reason for that? The reason for that is that there was program trading on the weekly time frame, and that's the beauty of it. Program trading was actually taking profits here, and this is the weekly setup, program trading setup in this market. So see, there are different algorithms. There's different algorithms trading this market on the weekly, on the daily, and actually on the larger markets, algorithms are trading in all time frames. So now you understand why we saw this initial profit taking here, which is very clear on the daily time frame. And on the daily time frame, in fact, we had this move lower. So this level, the 08750, is the weekly profit taking, and this is the daily profit taking. So the market went down because it was pushed by the participants on the weekly time frame taking profits, but it went back into this area that we identified above, before, never broke the 085.08, and eventually went into hitting the first target before reversing. So I hope I hope I was able to link together all these concepts, the bandwagon theory, which explains the market, to the sequence of measured move, which can be forced on price by program trading. And of course, the next measured move failed. And that's where we knew that the market was actually going to retrace all the way into the lows years, and these lows are, of course, are the all the way halfway back between, which is the next measured move, right? So, this is really it, what I wanted to say today, and I'll be happy to answer your question. I hope you found this interesting. So before I answer your question, so if you want to start typing your questions, I'll be happy to answer them. In the meantime, let me tell you. So let me go back then. Can you take a live chart and show where we are in the bandwagon stage? Very good. Of course I will. So let's continue on the New Zealand dollar then. So if we go back to the weekly time frame, that's a very good question. Thank you, Dhruv. So if we go back to the weekly time frame, what we have here is we have lows to highs, first target hit, next measured move in the sequence. So in the weekly time frame, we could see profit taking, and this would be the correction, and this would be actually this is a place where some of the people are still long, but in reality we already know that at some point on the daily time frame we know that this sequence has failed. Sorry, this is the euro. This is not the one. So where we know that this is failed, we know that this is failed when a market breaks below this level here. And below this level here, we know there is no more hope for longs. And this should be really the level where you, lastly, you exit. Actually, of course, you should exit at the profit taking levels, right? We never wait. So this is an area where correction was undergoing. And then again, as you can see, not always the market gives those jolts back and forth. Here in the previous correction was very clear, and actually this was very useful, this backward move, because it allowed us to enter this market once the sequence of measurement failed. Here, this it didn't happen in the last setup here, and that's why it's very important to always study the sequence of measure move of the sequence lower. So we had already a sequence ongoing here, which is from highs to lows, and it hit first and second target, and eventually our confirmation came from when price broke above 0.8526. That was the confirmation that the participation of smart money here was enough to keep bringing this price higher. Okay. Now, when that happened, we also had an opportunity to enter this market, and how? By trading the first measure move long. It does not always happen like that, but when it happens, as you can see here, we have to take advantage of that. You have to enter this market and take advantage of that. And there is a systematic way to do that, and that's what I teach as well in my mentoring. So where we are at the moment, well, to establish where we are at the moment, Dhruv, it's very important that we don't have a lot of time. Let me wrap this up. So, see, we need to see where we are in relation to the target, and the first target is here. So we are in that phase in which it's too late to enter. So I'm being asked to wrap up, and so when do you do the fib from low to top and from top to low? From top to top. Well, when market moves in extension, I do from top to top, and normally I do from lows to highs. I will need to, unfortunately, wrap this up. It took too much time. If you have this question, please send this question to fibstalker@gmail.com. I'll be happy to answer them with a chat as well. So no worries about that. I want to thank you everyone. I want to thank FXBit, and I hope you found this interesting, and you can shoot an email to fibstalker@gmail.com. Thank you very much, and have a great day.